for several months on end, you could draw lines and say it was mostly a sideways move. But if you can have the vision to step back and see, wow, that was a decelerating trend line. That angle of the trend was unsustainable, and when it broke, it decelerated. I can take you right now, which I'm going to do, over to Trade Navigator, and we'll look at that same chart, current time period. That was in 2012, that picture. I'm going to show you the picture now in 2014, and look at what has happened. I've got so many lines, I'm going to have to emphasize them for you. Right there is the first angle. Let's see if that drew off there. Okay, you see that. Now, here's the decelerating lines. Look at this. That is the same line that has controlled the market since 2011 now. It is the same line that we're tracking. Now, here's what I wanted to bring up to you. And I mentioned this in Power Trader Sunday night. I don't know what the future is. I think we're very oversold. Big picture, I think we need a larger correction right now. But here's something I'm prepared for. I'm prepared for a third decelerating line to come through here. I'm prepared for this trend that we're currently trading right now to correct again and possibly continue to 18, 20,000, who knows how high, at an even slower angle of the trend. I'm prepared for that because it slapped me in the face and turned me upside down and stuck my head underwater and gave me a swirly back here in 2011 when the same thing happened. Now, that would complete our 1, 2, 3. 1, 2, 3. That would complete that before we can have a larger reversal. Alternately, there's another way I could count this, and I could alternately count this by saying that we had a first angle of the trend right there from 2008 up into 2010. That may be number one. This could be number two. The current one we've been riding for all this time now could be number three, and that could mean that if we complete this reversal that I think we're in right now, let's zoom in current time period on the Dow Jones. If we complete this reversal, which, by the way, do you find it ironic that we found buying pressure at that current trend line that has been in play now since 2011, the decelerating line? That's approximately where we find our buying pressure last week in the face of extreme bearishness. Do you find that ironic? I don't find that ironic at all. Long lower candle shadows. We have a little line here. Obviously, there was some support at 16,000, but there was also that trend line that was running through there. Now, the question is, will we find support there and continue higher, question mark, or will we potentially, starting in the next couple of days, trade back down, break that trend line, and continue making lower lows? And the answer, Dale, right now is I don't know. We're going to have to wait, and we're going to have to watch and see. We do know what the options are. We know what the possibilities are. And so, I think today it's really interesting to me today and very, very important. We're kind of getting off our lesson, but it's really interesting that we have this long upper shadow today after a very big 300 plus point day. And then we had such a large sell-off later in the day. The same location that we've been having some other pivot point type of activity recently. Now, I had originally thought we would see a head and shoulders pattern here on a weekly chart. That I'm getting a little advanced for some of you. We had on a short term, on the daily chart, we had a very clunky head and shoulders pattern. That right shoulder was just ready to collapse as soon as it formed. But we had a head and shoulders there, but I was looking for one on a larger scale. Originally, Dale, I was anticipating that we would not have sold off that far. I didn't anticipate that, Dale. I thought that we were going to sell off to right here, which we did do, but then we kept selling. So I was anticipating a sell-off to about 16.3 and then a rally to 17.2 and then a sell-off. What you see happening here, Dale, is a little bit of a different pattern where we actually broke that 16.3 support. You even saw the target there. We broke below that. We came down to the next level of support. You see this line that's run through here? So that was a known area. We got the buying pressure in here, indicated by those lower shadows. Now, this is a problem. You see how low this volume is? This volume should be picking up radically for these bullish moves. This is a weak rally. Dale, I can't be bullish on this market until I make higher highs or something happens, because right now it looks very, very weak. We've got very average, below average volume now in the rally. And today we've got that selling pressure coming in at the same pivot area where we've had turns happening before. So, Dale, it's a little bit early to tell, but I'm still a little bit on the bearish side. I don't have quite the optimism that you hear on television. All right, I'm just way off on a tangent right now, but I think it was probably valuable to talk about that. Let me show you another interesting fan line. I want to show you American Express. This one drove me crazy back in the day. Take a look at that decelerating fan line, ladies and gentlemen. I mean, if that won't make you pull your hair out, nothing will. That is not a Fibonacci fan. That is an actual decelerating fan line as it occurred real time that I drew in there. Initially, we had some trading channels in there, or trading lanes, I mean, and then we started to break. The first angle was right here. 1, 2, 3, 4, 5, 6, 7. That most recent one, these last two, look at this. This is not even trading inside of a trading lane. American Express is consistently trading inside this fan. It's bizarre. I can't tell you another time I've ever seen that happen before, but it has happened. And these fan lines all come off the 2008 lows, and they've been holding true until last week. That lower line had not broken. That lower line had never broken until last week. And, of course, look at where we sold off to last week. We sold off to a known support level. Now, today, look what's happened. We've rallied back up in here. We're back up into a resistance area. What's a principle that we learned tonight that could be very practical here? We had support, 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 broke support, come back up. Old support becomes new what, Dale? Old support becomes new resistance. That's correct, Robert. Old support becomes new resistance. And so this is a great example as we're in potentially a market turn. And by the way, when we learn chart patterns in level 2, you'll learn there's a very typical pattern where it breaks below support, comes back up, tests it, and then it continues the reversal. I think we're in a classic reversal right now. It's a little early to confirm that, but we've got lots and lots of reasons to believe that's in play. Let's see if we got anything fun on Caterpillar that I want to talk about. I don't think I have anything too fun in terms of fan lines. In terms of old support, new resistance, this is kind of fun. You know, Caterpillar had new earnings today. This was my bearish trade of the week about a month ago when we were in Power Trader, right after this move had broken here. This was a double top pattern that broke. We'll talk about this in the patterns classes. But look what happened. We sold off to support. That's known. That's expected. We rallied out of here. And even on the big earnings, where did we trade to? We traded to old support, that is new resistance. And if I zoom in on this even further, you can see all that selling pressure that started to build up. Tomorrow morning, I expect that Caterpillar is going to rally just a little bit more, right on up into that area. And then I would anticipate we'll stop, and then probably the bearish trend will continue, because Caterpillar at this point has all the makings of a bearish trend. In fact, that was my trade analysis for Power Trader this past Sunday night. Even though I was extremely bearish, you can see my two bearish triggers, 103.11 and 98.55. Those were my two bearish triggers during this trend. We rallied out of this. Sunday night in Power Trader, I told our students, I said, anticipate a rally, and then once that rally happens, and then it turns again, that's the next selling opportunity on Caterpillar. This was a great trade, and lots and lots of money to be made on that one. I got a lot more to teach you tonight. Let me not get lost in analysis. We can spend all night doing analysis. So can I continue teaching the core stuff? Are we good with that example? Went through about 5 examples there. All right, let's continue here. Quick recap. What's the purpose of all this line drawing? What do you think all the purposes are that we're building up here, Edmund? Here's the purpose. It gives us a framework. It gives us a visual representation of the trader sentiment, defines our zones where the stocks make turning points, also known as pivot areas, and it helps us determine a trading direction. And Edmund, it helps us determine our price targets. This is ultimately what we're working towards, Edmund. We ultimately need to know, where do we get in and where do we trade to? If we've got those pieces of information, we can start to set ourselves up with a trading plan. How valuable is that? Okay, so Sandy, that's what I want to talk about now. Let's start building the foundation of a trading plan, and this is going to build around the concept of entries and exits. How many of you have instituted historically the world's worst trading plan? Just confess it. We're in a safe room. If we were in a live room where I could give you a hug, I would give you a hug, because we've all got the scars on our backs. This is the trading plan for most people. You ready for this one? Buy, hold, and pray. Go ahead, confess. How many of you have done it? You buy a stock, you hold the stock, and you hope and pray that it goes up and it does what you wanted it to do. Or maybe you've shorted, you've held, and you pray. But the point is, you enter a trade and you hang on for dear freaking life. Thomas says he even gets down and kneels at the end of the bed. Well, Thomas, I'm all about praying for the right reasons. Praying because you did bad analysis and you placed a risky trade. Sorry, even God's not going to bail you out on that one. Let's talk about the right way to do trade analysis. But before we do that, I need to drink some water. Give me 1 second here. I think I just said the right way to do trade analysis. Did I just say that? I did not mean to say trade analysis. Line drawing is the beginning of great trade analysis. I meant to say the right way to do a trading plan. How do we set this trade up the right way? That's what I was thinking. It just came out trade analysis. All right. Here's the right way to set up your trades. Number one, you've got to have a clear plan. You've got to have a clear plan. Lorenzo, if I told you you've got to have a clear plan, do you have any idea what goes into a clear plan? How many of you, thinking about that before you even get into the trade, know exactly what goes into making a clear plan? Any idea? The first piece of information you've got to have is you've got to have a specific entry price. If you don't know your entry price, you don't have a plan. But just having an entry price does not mean you've got a plan. It just means you know where you're getting into the trade. The next piece of information you've got to have is a specific target, or in some cases, you can have multiple targets. You can kind of scale into them. But you've got to have your target defined, and you need to define where you're going to set your stop. Without these three pieces of information, Lorenzo, you don't have a plan. All right, so Lorenzo, the good news is I just gave you the perfect blueprint for a plan. Have an entry, have a target, have a stop, and then trade that plan. We're going to get more specific on trading plans coming up in a couple classes, but let's just understand the basic idea of what we're trying to accomplish. Edmund, now that we've got our line analysis, now that we've got our support and our resistance, we've got our fan lines, how do you think we can possibly come up with a way to set a specific entry, a specific target, and a specific stop? Any ideas, Edmund? Or any of the rest of you? We're going to use our framework. That is exactly correct. Use our support and our resistance to set the trade up. Good job, Edmund. Edmund, I told you you'd pick this up. I told you could do this, buddy. All right, so let's talk about that framework. Our framework really comes down to pivot points. Pivot points, remember, are just support and resistance. That's all it is. Any support or any resistance point is a pivot point. Now, the way we can define a pivot point, and you should all know this, a pivot point is the place where the people trading the stock will make a decision to either trade higher or to trade lower. You are never going to need to walk into a brokerage and talk about a pivot point. You're never going to need to bring it up at dinner. But you better know before you get into your trades and before you get out of them where those pivots exist. Because you're the one making your trading decisions, and your pivot points will define the structure of your trade. I've already told you the answer, but some people have a hard time making the vocabulary leap. So let me make it for you. Support or resistance is your pivot point, period. That's all it is. Support and resistance are pivot point. Support and resistance are the function. You've got the selling pressure or the buying pressure. Pivot point is the application. Pivot point is, now that we know the function, where the buying and the selling happens, the pivot point has been identified. Now we know where those trading decisions occur. You need to understand those concepts because that's the foundation of all the trading that we're doing. Now, the more times that a stock hits a pivot point, obviously the stronger it is. It's a turning point. And previous pivot points become the location that you can set your trade up for and where you're going to be trading to in the future. Previous pivot points become future price targets. They become your entries and they become your targets, Edmund. So once we have used our framework, once we've built our framework, we have got the general structure for the trades. So let's come over here and take a look at this trend here. We got a trade that's going on along here, making higher highs, higher lows. We break out. We've got higher highs and even higher lows. And then, the unthinkable happens. Our trend breaks. We're trading down. Where do we go, Edmund? Where do you think the next target is? We're going to extend our trend line, and our previous trend line, which is the same angle of the trend, it's still part of the same trend, is going to become our next target. By the way, this picture that you see right here, that is a counter trend trade. That is one of the most difficult trades to make profitably. When you're in a bullish trade and the trade is going counter to the trend, going sideways to downwards towards the trend line, that's one of the most difficult trades to make for a profit. I always try to coach my students away from trying to make that trade. It's very difficult. What you would rather do is you'd rather wait. The trend line has broken, Edmund. You want to wait until we get to that first target, and then when it turns higher, there's your buying opportunity. Now you're buying in the direction of the preceding trend. Trading counter trend is very difficult. It's one of the rules I really try to avoid when placing our trades. All right, now, the next thing that happens, what if we trade down to the trend line and that support level breaks and it breaks through? Now, Edmund, where are we going? Well, now you got a good reason to place a bearish trade. Where's our next target? Our next target is going to be our previous pivot point, which so happened to be a support point. Boom, that's our next target. Now, what happens when we get here? We got two choices. The stock could go up or the stock could go down. Which one's going to happen? Dale, what's going to happen? Is it going up or down? I don't know. And frankly, I don't care. But if it goes up, I've got a great buying opportunity. And if it goes down, I got a great selling opportunity. Really doesn't matter. I do know that if it goes down, my next target is going to be this previous turning point. How many of you guys can understand that basic idea? All we're doing is we're trading from pivot point to pivot point. Now, Sean, imagine that you come into a stock you've never looked at before. You get your grid built. You have your framework. You know your horizontal support and resistance. You've got your basic trend line defined. And you need to go place a trade. Do you have more confidence or less confidence placing a trade and trading it to a pivot point rather than buying or selling and holding on for dear life and hoping and praying that you were correct? For most of you, this is going to transform the way that you trade, because what we're doing is we're defining the trades before we ever get into the trades. Make sense, John? All right, let's take a look here. Pivot points for entries. Here's how it's going to work, Edmund. When a stock trades to a pivot point, you pretty much are guaranteed that this trade's about to do something. Now, you don't know what it is. And that's the challenge, Edmund. You don't know if we're going to go up or down. But the good news is we know we're going to do something. You see, when you're in a bullish trend, you have no idea if this stock's about to reverse. When you're in a bearish trend, you have no idea if the stock's about to reverse. When you're at a pivot point, you know this stock is either going up or it's going down. Praise God. Finally, I can pick something. Something's going to happen. Now, this is great. Now that we know something's going to happen, what are you going to do, Edmund? Oh, you're going to guess, right? No, you're not going to guess. What are you going to do? You're going to wait, and you're going to let the stock talk to you. What if I told you that your stocks are speaking to you? What if I told you that the stock is telling you which way it's going to go before it goes there? What if I told you that? You'd say, you're lying, Jeremy. Well, I'm not really lying. I'm just telling you that this is more like a martial art. Are any of you familiar with the martial art of Aikido? I went to this thing a couple years ago, and they decided that they were going to use the martial art of Aikido as a metaphor. And it had nothing to do with trading, but it was the best trading metaphor I had ever heard in my entire life. I couldn't believe it. In fact, I left that conference thinking, I'm going to go meet that Aikido instructor, and I'm going to learn about this so I can have my trading metaphor, and I never met the guy. And so I've never gone any further with it. But I learned in this one little 1 hour session about the martial art of Aikido that in the art, you don't necessarily be proactive with the move. Instead, in the martial art of Aikido, you wait for your opponent to come towards you, and then you use their energy against them. Think about that. You don't make the proactive move. You let your opponent come after you, and you use their energy against them. It's a shift. It's a transfer of energy. You can actually be extremely weak and extremely small and defeat a large person that's attacking you if you use their energy against them. That's the idea that we're going to use here. Instead of trying to anticipate, instead of trying to be proactive and make the first offensive move, we're going to be reactive, and as the stock starts to tell us where it's going, we're going to jump on board, and we're going to take the move with it. Let me show you what I'm talking about. The way we're going to do this is we're going to use trade triggers. So we're going to set a trigger above and below the pivot area. Above and below. Now, if the stock moves bullish, boom, we're into a bullish trade. And if the stock moves bearish, boom, we're into a bearish trade. And Edmund, the beauty of this is you don't have to guess. You just get to follow. That is the value and the benefit of setting your trade up this way. Using the trigger is going to help you limit yourself to the trades that you actually want to get into. And more importantly, it helps get you into a trade while the trade is moving. How many of you have gotten into a trade before, and the minute you enter the trade, you kind of sit there and it flounders for maybe 2 or 3 weeks, and you got to wait? There's nothing that's more painful or annoying than waiting through one of those trades. Oh, it is like a root canal, only you don't get the good drugs to go with it. It's just awful. What you want to do is you want to get into the trade as the momentum is picking up, ride the momentum, and then you get to your next pivot point and get out of the trade. That sounds like a much better way to trade, doesn't it? So let's come over here and let's look at this John Deere trade. Unfortunately, I can't zoom in very well in this picture right now, but you can see it. And you can see the basic idea is we've traded down here to a support level, and we don't know. Are we going up or are we going down? I don't know which way it's going. I just know that it's going to go one way or another. And so if it goes bullish, well, we'll enter bullish, and we'll trade up to this target. And if it keeps going, we'll trade to this target. And if it keeps going, we'll trade to this target. What happens if it turns around and goes bearish? Well, if it goes bearish, we'll trade down to this target. And if it keeps going, we'll trade on down to this target. Well, what happens if the stock gets stuck and it just keeps doing this? We're going to sit on the fence and we're going to wait. In other words, Edmund, we're not going to get into the trade until the trade tells us, hey, I'm ready to go. And when it says, hey, I'm ready to go and I'm going up, we're going to jump on board. We're either going to buy the stock or we're going to buy some call options. We're going to jump on board in that direction. Or if the stock breaks down and it hits our trigger, then we're going to jump on board and we're going to trade bearish with it. Now, this brings up a really important subject. Where do we set the trigger? Where do we set the trigger? And the answer is you've got to give yourself enough room for the daily volatility. Any trade on any given different stock is going to have a certain amount of intraday volatility. More expensive stock is going to have more volatility. It may be on a $200 stock. You may have $8 or $10 or even $15 worth of typical volatility for the day. You don't want to set your trigger inside that. On a less expensive stock, it may only be a couple of dollars worth of volatility. Unfortunately, it's never the same. And so, you can try to estimate it by using your average true range or some other tools. But, really the best thing that I have found is just look at it. Just use your eyes. You got two of them. And if you use both of them, you can probably see that in general, this trade kind of, has about that much volatility. What is that much? I don't know. But I do know that that's about the amount of volatility it has. So what I can do without knowing the specificity of the dollar, you can look at this and you can say, you know what? That's my typical daily volatility. I need my bullish trigger to be above that. So I can sit here and I can do this within the day. And I need my bearish trigger to be below that so that I can sit here and go back and forth and not get stuck going bullish or bearish when I don't mean to. What far too many people do is they'll come in here and they'll set a bullish trigger right there. They'll be like, yeah, I want to get in right on the edge. And the trade will come up and it'll do this and it'll come down here and do this and then do this. And then they're wondering why they got into a bad trade. Well, you set your trigger so stinking tight that the intraday volatility got you. Worse is they'll set a trigger to buy right in here and they'll set a stop right down here, and then they can't figure out why the next day they get triggered into a trade, and before the day's over, they're out of the trade because one candle can wipe you out. You've got to give yourself enough room for that intraday volatility. And again, the best way to do it is visually. So I can sit here and look at this, and I can say, well, if I break out above that price point right there, I'm probably moving bullish. So that becomes my entry. You say, what price is it? I don't know. I draw a line on the chart, and then the chart tells me what price point it is. I'll go show you this in just a minute. Or I look at this and I say, well, if I break down below this support level, that gives me enough room below my recent volatility. I think this trade's going bearish. You say, what price is that? Well, I don't know. We have to look at the chart, and then the chart's going to tell us what price that is. But you got to give yourself enough room for that intraday volatility. Look for the recent swing highs or the swing lows. This is one way to find it. So, right in here, that's a swing high point. Right in here is a swing low. And you say, somewhere below here, that's going to be my entry point for a bearish trade. The daily volatility, the swing highs and lows of the intraday move, that's very important. Christy, you cannot find that data on a line chart. You've got to be using a candlestick or a bar chart for that, okay? You can use the previous day in some cases, Robert. Not in all cases, but in some cases you can. But you're just going to have to work with it. This is an art, not a skill. Not a science. It is a skill. It's an art, not a science. Make sure that you're not running into another pivot point. Worst thing that could ever happen is you set your bearish trigger right here, and you fail to realize that you've got another support right here. So you get into the trade, and 45 cents later, you're hitting support, and you're like, I can't believe it. I can't catch a break. Well, you could have caught a break. You just didn't realize there was another pivot point right there. So again, this is a lot more art than science, and that drives some people crazy. But once you understand it, once you build this skill set, it's going to be invaluable. I mean, it's going to be one of those skill sets you're going to look back and you're like, I can't believe I ever traded without doing that. And so I just want to encourage you to practice it. Practicing is the best way to get better at this. You're not going to be perfect the first time. When we get to level 3 and you learn the trader conditioning process, that is a place where you'll be able to hone this skill a lot better. But it is a skill that you're going to have to build. And so I'm teaching you the principles tonight. You're going to have to go start developing that skill set. Let's start understanding the ideas of the triggers here. Any previous pivot area can be the place of a pivot, obviously. That sets up the trigger. It also sets up the future price target. So any previous pivot area is a future target. Usually, more often than not, the stocks will move to that major turning point. It doesn't always happen. It doesn't always go exactly to the penny, but usually, more often than not, stocks do not stop in no man's land. Most of the time, they will go to a known turning point, more often than not. And when I say more often than not, I'm talking 90+% of the time. It's rare that a stock just stops in the middle of nowhere. It just doesn't happen that often. Once you've got your pivots identified, you understand where your targets can be. Once you've set your entries, look left. Remember, we're looking at historical trading behavior. So we're going to look to the left, and we're going to find the next pivot point, and that becomes your next target. All right, let's get over to Trade Navigator and let's finish off our Celgene trade setup. We can do this now that we've gone through all this. By the way, just looking at the clock, some of that analysis I did is going to cause me to go over just a little bit. Forgive me. We're going to be just a little bit beyond 90 minutes tonight. All right, with our Celgene trade, if today's candle were not there, because the truth is the candle's there, so I got to react to what's there. But if today's candle were not there, I could have set this trade up very simply. Here's how I would have done it. I'm going to use the little tool in Trade Navigator called the Support and Resistance tool. It's got a little sideways line and a little bullet on the end of it. I use this tool because I can just draw a point on the chart and it gives me a price. That's how I know where my trigger gets set. And so what I would have done if that candle were not there today, in fact, let's make the chart look like that. If the chart looked like this, and that's how it should have looked without today, there we go. Then I would have put this trigger just above yesterday's high, because this is our resistance area, and you can see that pretty clear. That's the resistance. We've hit that a couple times. Excuse me. Yesterday, 2 days back to back, we traded up into it on, what is today? Today's Thursday. So we traded up into it on Tuesday. Then on Wednesday, we traded it slightly above it. We pulled back down below it. And I'm looking at this, and I would say, based on this trading behavior, if we broke out above about 97.36, you say, well, where'd that number come from? It's visual. I don't have that number to just pull out of my butt. It's just there. I draw it visually. I don't have a specific formula for it. But visually, I can draw it in there, and I can say, if this price moves above that, this trade is probably going bullish. Well, sure enough, today, that's exactly what happened. So today, you should have gotten into Celgene, at about 97.36. That should have been what happened. Now, we're a day into this thing. What do you do now? Well, now we're going to hold it, if you're into the trade, up until about 102. But that's our next target. Our next target would be 102. And since our next target is 102, you don't want to chase this thing tomorrow. So if you did not get into the trade today, then you missed your opportunity and you don't want to chase it. If you did get into the trade, then great, you're into the trade. Your target's going to be about 102, and you got about $1.70 to go, $1.60 to go before you get there. Okay? Now, let's talk about moving forward on this trade. Where else would I have set that trade up? Alternately, again, I would have set a bullish trigger right up here, about 97.42 or so. Bearish-wise, I would have looked at this yesterday, and I would have said, I got a gap here. If I can get below that, about 62, well, that would be hitting resistance, and it should be coming down. I've got a recent sell-off at least to $90, and there's a good chance this thing could go back down to 85. So yesterday, before today's breakout, I would have put a trigger at about 92.62, which would be just below that gap that we had. It was right at the bottom side of that gap that we had a couple of days ago. That's how I would set the triggers. Again, I do it visually. And then what that tells us is if the stock goes up, boom, we move bullish. If the stock goes down, then boom, we're going to go bearish with it. Did I answer your questions about setting the triggers? Do you guys see how I would come up with those numbers? I think I've said enough about that, but if you need more clarification, this would be a good time to maybe ask it. Let me show you how you use that data. Now that we have set the trigger, now that we have an idea of where it should happen, how do you set the trade up? How do you actually execute it? So here's what we're going to do. We're going to come over here and we're going to set, there's two ways that we can execute the trade. One way, excuse me, I got something happen in my throat now. One way we can execute the trade is you can just stare at your computer all day and make the decision in real time. How many of you are really good at making real-time decisions when the price is moving on you? Anybody here really, really good about that? Yeah, most people are not. If you are, good job. Give yourself a hand on your back, pat on your back. But, most people are not really great at sitting in front of the computer and making good quality decisions while the price is changing. So what I would prefer to see is you set an order that we would call a contingency order or a criteria order. So I want to walk through that with you right now. If we came back over here to this John Deere trade, we set this basic trade up and we said, if we go above that price point, we'll trigger bullish. If we go below here, we'll trigger bearish. Well, you can look at that. You see that's $74 and this was 77 something here. So let's go over into an order form and see how this would get set up here. Let's do the bullish side first. So the bullish side, we'll fill out the order ticket the same way we talked about in the last class. Everything about the trade, here we're going to buy the stock, the actions to buy, set our quantity in here. In this case, we can do a limit price or we can do a market. I would suggest you change that to a market because it's going to become a triggered trade. Now with stock, it's easier. You can set the limit price at the trigger price as well. So you can do the limit a little bit easier. With an option, it's a little bit more challenging because you set that trigger with your option and you're not quite sure what the price is going to be for your option when the stock hits that price point. So that's a little bit more challenging. With a stock, you can still do the limit trade. So I don't care if you do the market or the limit. Then you put the price point in there. Now here's how you're going to set the trigger though. Look on this screen here and up in the upper left corner, there's a little box, check box, I think is what you call that. And it says trigger. Guess what that means? It means it's a way to set a contingency order that will trigger your trade. So we just filled out the order form for the basic buying the John Deere. Now let's set the contingency or the trigger. So we click that box and boom, now we have two tabs. The first tab is the trigger criteria. The second tab is the actual order. Now, the way that a trigger works is the trigger sets the criteria, and if that criteria is met, then the order will be sent to the floor. Otherwise, the order just sits in the computer and nothing happens. So, there's several ways you can set the criteria. In Options House, you can choose to set it based on the stock, based on the option, or based on the time. And then you're going to see over here in the next section the conditions that must be met. So I've already filled this in for us. The condition is that the last price of the stock is greater than $77. That's my trigger. If the stock is trading at $77 or higher, if the last price is $77, then go send my order to the floor to buy John Deere stock. Now, do you see what's happened? We are not sitting at the computer waiting for our criteria to be met, but rather, Edmund, we set the criteria up and the computer will do the work for you. That's how you can have a day job and have your trades trigger. That's how you can get the computer to do some of the painful, boring work for you. All you've got to do is do the right analysis, tell the computer the boundaries, and your computer will do the work for you. Now, in the bottom left corner, you're going to see the summary, and it will say if, there's your contingency, if DE, John Deere stock, has a last price that is greater than $77, that's a day order, then buy 100 shares of John Deere stock at the market price. That's going to be a day order as well. You hit preview and boom, you're off to the races. Let's do the same thing for a bearish trade. For the bearish trade, we're going to set the John Deere trade up, but instead of being a long trade, instead of buying, we're going to be selling short. Okay, we're going to do 100 shares at a market price, and we're going to click on the trigger, and here is the contingency based on the stock price, the symbol John Deere. If the last price is less than, and according to our chart, that number was $74. If the last price is less than $74, then do what? Then trigger my trade. I don't want to get into a bearish trade while the stock's up here at $75, stuck at my pivot point. I want to get into the trade after the stock has hit my trigger and it's ready to move to the next point. So, if the stock comes down to $74, then go sell short 100 shares of John Deere at the market price. If, then. That's how you set a trigger and how you make your broker or your online trading platform do what you're trying to tell it to do without you sitting there having to press the button in real time. Now that's pretty powerful, isn't it? Now, Robert says, would you wait and have it happen after 10 a.m., after the first hour of volatility? Not necessarily. That's kind of a little more old school, Robert, that you should avoid the first hour of volatility. A lot of times today, Robert, the stock in the first hour will make its entire move, and then it will stabilize for the rest of the day. So, sometimes you want to get in early in the morning. But if you do want to set that, Robert, you can do that at night too. You can set your time. You can select this checkbox and you can say only if it happens between these hours. So you could say if John Deere has a last price that's less than $74 between 10 a.m. and 1 p.m. I don't want to do it in the first and the last hour. You could do that, Robert, as well. Yep. Makes sense. You can do the same thing at Options Express. Absolutely. You can do the same thing at Thinkorswim. Different brokers call them different things. The way that Options House has set it up, I actually really like the way they've set it up. They call it a trigger, and you've got conditions in here. Options Express, I think the word Options Express uses is contingency. I'm mixing brokers up now. They may call it criteria. I'm confusing my brokers. Some brokers call it criteria. Some brokers call it contingency. Some brokers call them conditional. The idea is if then. If a stock does X, then do Y. And that's the idea. So whether you call it conditional or criteria or contingency, whatever you want to call it, it's the same principle. And the certain criteria has to be met before the order will get sent to the floor. Does that make sense? And by the way, if you're a young trader, I would encourage you to trade almost exclusively with contingency orders. Today I'm more disciplined, and I have the discipline to sit at the computer, and if I'm watching a trade and it's not met my point, I don't have to pull the trigger on it. But when you're learning how to trade and you don't have that emotional discipline, it's really important that you let the computer help you out. It really is. All right, guys, let's wrap it up here. I got some homework for you. This was a very full class. There was a lot of information. You're going to probably want to go back and watch the recording of this. I'm getting these recordings posted up within about 3 to 4 hours of teaching them. So you can go back and watch these new recordings. They are getting posted up, and you can go back and watch them. I probably am going to encourage you to do that for tonight's class, especially if it seemed like it was going fast. Since we also had some delays, that's a good idea. Here's your homework. Work on drawing your trend lines. Continue working on drawing your support and resistance lines. See if you can draw some fan lines on your charts. See if you can find some fan lines. A lot of those have been breaking in the last recent 2 or 3 weeks, but throughout the summer, we had quite a few fan lines and a lot of really great things going on. So there's a lot of great stuff to draw on. Practice determining your price targets. Look for your pivot areas and say, that's my price target. And in your virtual account, I'd like for you to work on setting up some contingency orders and placing those trades in your virtual account. I want you to keep it virtual still. Prove to yourself you can do it with fake money before you put real money on the deal. If you need some help, maybe this would be a good time to go on the TradeSmart community website, ask for some help. If you need to call a student success coach, this would be a great time to do that. And Mike will be happy to help you out there.